In this lecture, we conclude our three-part study of acquisitions and dispositions of web-based businesses. This lecture covers the rules for disposals of intangibles. The objectives of this lecture are to understand the general rules for disposals of intangibles, including when a sale will be taxed as either a sale of a capital asset, property used in a trade or business, or ordinary income. Understand the difference between a transaction taxed as a sale versus one taxed as a license. Examine the special rules for disposals of software, website content, patents, trade secrets, know-how. Section 197, intangibles. Section 174, property, and domain names. Let's first look at the general rules. When a business disposes of an intangible, it is usually taxed as either a capital asset or property used in a trade or business. Alternatively, disposal may be taxed as an abandonment. When a business entity sells an intangible that is not used in a trade or business and has not been subject to amortization, then there is usually the sale of a capital asset taxed under Section 1221. This rule is discussed in the text in the context of sales of domain names, but applies to other intangibles. Under Section 1221, both gains and losses are capital. On the other hand, if an intangible has been used in a trade or business and has been subject to amortization, then a sale is ordinarily subject to Section 1231, also discussed in the text, and gain will be treated as capital gain, while a loss will be ordinary. An intangible can also be abandoned. For example, a web-based company may abandon its domain name by failing to pay the fee required to continue registration of its domain name. As discussed in the text, when a domain name or any intangible is abandoned, its remaining cost is usually written off. However, as we will see later in this lecture, under special rules applicable to intangibles resulting from expenditures taxed under Section 174, unamortized cost may not be immediately deductible on abandonment of the intangibles. There is a dramatic difference between a disposal of an intangible taxed as a sale versus one taxed as a license. A sale of an intangible generates gain or loss that may be ordinary or capital. A license results in ordinary fee or royalty income. In the context of transferring software to a business, there's a transfer only if the rights in the intangible are completely transferred. In the case of software, for example, the copyright rights must be transferred. In the case of a disposal, if there is no complete transfer of the rights, then there is no sale. If only the use of the intangible is transferred, then the resulting payments are ordinarily classified as royalties or fees. Having covered general rules, let's look at some special rules. The first rule applies to software copyrights. The disposal of a software copyright follows the general rules for disposals of intangibles, unless a special rule applies. There is an important special rule for software copyrights. As discussed in the text, the sale of a copyright generates ordinary income if the seller created the copyright. This rule applies to a software copyright. In applying this special rule, the key question is, who is the creator of the copyright? This question is discussed in the text. If there is a desire for capital gain, this can be achieved if software is patentable. As discussed in the text, the sale of patentable software can result in capital gain even if sold by the creator of the software. Let's talk about sales of copyrighted website content. Very simply, the sale of copyrighted website content follows the same rules as for copyrighted software. Both represent sales of copyrights. The sale of patents, trademarks, and know-how follow their own set of rules. If no special rule applies, sales of patents, trade secrets, and know-how follow the general rules for sales of intangibles. However, there are some special rules. First, let's talk about patents. A patent is eligible for capital gain treatment under Section 1235, even if the seller is the creator. Likewise, trade secrets and know-how may be eligible for capital gain treatment under Section 1235. What happens if we dispose of a Section 197 intangible? The sale of a Section 197 intangible follows the general rules for intangibles unless a special rule applies. There is a special rule that applies to the sale or abandonment of Section 197 intangibles. This rule is provided by IRC 197 F1A. Under this special rule, where more than one Section 197 intangible is acquired in a single transaction or a group of related transactions, if a loss is realized on the sale or abandonment of one of those intangibles, the loss is not recognized. Instead, the loss is reallocated to other Section 197 intangibles acquired in the same transaction. This is accomplished by increasing the basis of those other intangibles by an amount equal to the loss. In the case of covenants not to compete, there is another special rule. Under IRC Section 197 F1B, a covenant not to compete that is a Section 197 intangible is not treated as disposed of until the entire business interest to which it relates is disposed of. Let's talk about the disposal of a special category of intangibles, domain names. As discussed in Lecture 4-1, the nature of a domain name is somewhat ambiguous. And depending on the extent to which goodwill attaches to the domain name, the domain name may be considered either a trademark equivalent or some other type of intangible. If a domain name is a trademark equivalent, then its sale may be taxed under the special rules of Section 1253. It can also be taxed under Section 1231. And if it is a Section 197 intangible, it may be subject to the special rules for disposals of Section 197 intangibles discussed earlier. To the extent a domain name is not a trademark equivalent, then its sale may be treated as the sale of a capital asset under Section 1221 if it has not been amortized, or if it has been amortized, then its sale may be controlled by Section 1231. As an exception to the rules for the taxation of the disposal of intangibles discussed so far in this lecture, There are special rules for property accounted for under Section 174, where property was acquired as a result of R&E expenditures paid or incurred in tax years beginning after 12/31/21. As discussed in the text, where property was acquired as a result of R&E expenditures paid or incurred in tax years beginning after 12/31/21, the cost of such property is amortized over 5 years, beginning at the midpoint of the year in which R&E expenditures were paid or incurred. If such property is disposed of, retired, or abandoned, no deduction is allowed with respect to such disposition, retirement, or abandonment. Instead, amortization continues as if the taxpayer still held the property for use in the business.